Hello, thank you for taking your time and listen or watching then this video. As I've mentioned then in a class that I won't be able to have then the live session that's supposed then to be on the 3rd due to then some commitments. So in order for you not to miss out, I've decided then to make this recording of chapter 14, the introduction on that chapter. So I'm sure that you are going to benefit as it would be then when you were in a class. So let me do the presentation once again. These slides then they are available. Then if you can check then in your folder, chapter 14 folder in your Microsoft Teams, then you'll be able to see then these slides. They do then appear there, as well as additional exercise for your practice. So chapter 14 is about direct and absorption costing. So these are the income statement. So here what we are doing then we're just doing the report. Remember, each and every organization at the end of the day want to see whether then they've done a profit or not. Hence then we said, okay, therefore we have then to just do then the income statement and show them look, this is how then you perform. So that's the main purpose. But then I will look again, but what's the difference between the two, that is direct and absorption. So that's what we're going to take you through. The outcomes and of then this chapter is for you then to be able then to display the competency on how to prepare then these financial statements according then to the two method, that is your direct and absorption costing method. Then looking at our introduction, so we started with absorption costing method. So in this introduction, then it's a matter of explaining how then the two methods differ from one another. So when we look at the absorption costing method, manufacturing overheads are assigned to production. So when we say that manufacturing overheads, we're talking about then the entire manufacturing overheads then that we have. So they are assigned into then our production. Then cost of inventory reflects all manufacturing cost, including the fixed manufacturing cost. So it's not only then the variable manufacturing overheads only. Cost of sales will include fixed manufacturing overheads relating to goods sold. Closing inventory will include fixed manufacturing overheads relating to the closing inventory. Overheads allocation must be done in a constant manner. Now you could pick up that the difference and then that we learn and that we can say that we notice here is how we treat the fixed manufacturing overheads. So if then is what then you've picked up then from this explanation, then you are 100% correct. As you can see then this figure here that explains clearly then what do we need then to add in order then to do the calculation of a production cost or a product cost under our absorption costing method. It's your direct material, direct labor, variable manufacturing overheads, plus and the fixed manufacturing overheads. And I can tell you now, guys, and that's the difference between the two methods. The difference is how then we treat then the fixed manufacturing overheads. Under absorption costing method, fixed manufacturing overheads form part of the product cost, of which under direct method then is an period cost. So from there, then we can be able then to go and to the account that represent the production. That is your work in process account. And whatever then we finish from that work in process account, it will go then to your finished goods. Then you can draw up then your comprehensive income statement thereafter. Then looking at the direct method, we've already touched on a bit on that. So we call it direct, or we can refer to it as a variable or marginal income statement, consists of mainly used for decision-making purposes. That is why then others then they will refer then to this type of income statement as your internal income statement. Even you'll see then the terminology that we use when we draw up then the income statement according to direct method. It tells you that this is an internal document. Only then those people then who are internal then who can understand But what are we talking about? Fixed manufacturing overheads are not included when valuing inventory. Fixed costs are treated as period cost. Can you see then that difference between then the two? As we've mentioned that this is then how then we find then the difference between the two methods on how then we treat the fixed manufacturing overheads. We said that under the absorption, they form part of the product cost, but here in direct costing, then we treat them as period cost. In other words, then what we're saying is that in actual manufacturing overheads are expense and not absorbed into the cost of goods sold, and as well as in your valuation of the closing inventory. So that's the difference between then the two. Now look at this figure then that shows how to work out your product cost under direct method. Once again, it's your material labor, variable manufacturing overheads. Then that's it. We don't have then the fixed there, then I will go to the production finished goods then and your financial statement. Then when you draw up your financial statement, you'll have then amongst then your expenses, your actual fixed manufacturing overheads as part then of those expenses then that you have. So that's the difference between now the two methods. So that's it. So we look at this method, then we're going to take then the example then that is going then to assist us then to demonstrate how we draw this to the income statement. But before then we go there, then we need then to understand 3 steps then that we have then to take before we can actually draw out then the financial statement. The first step then is to, sorry for that. Our first step, guys, then is to work out then with units. So then we fill in then the missing units. Then the second one, then we calculate then the cost per unit. Then the third one, you work out then your over or under allocation. Remember then what they said about fixed manufacturing overheads that you need then to allocate them in the production. So these are the workings then that you have then to do before you can actually go and do then the income statement. Do then your units calculation, cost per unit. Remember then your cost per unit is going to be divided into 2. The first one then it will be as per direct method. Then you'll also then do then the one for absorption method. So then these are the 2 sets of cost per unit that you have then to calculate. So then we'll look at this example then and see then how are we going then to do that. So it is a very first example then in your textbook or questions. MJ Limited manufactures and sell a product. The company's fixed manufacturing overheads are located on the basis of machine hours. So that's very important information. So we need then to know then that allocation base bar. What do we use then to allocate our fixed manufacturing, our manufacturing overheads into the production? It takes then 2.5 machine hours to produce one product. Standard production for a typical month is 10,000 products or units. The budgeted monthly fixed manufacturing overheads amount to 350,000. You need then to be very careful about that. Make sure then the information that is given for you in terms of your production, the period then must be the same then with the amount, because sometimes they can provide you then with a yearly amount and give you then the information or the output of the month. So you need then to adjust that. So just have a look on that. They can trick you in the question. There were 1,500 products in the finished goods storeroom on 31st May. 20 times 9. MJ Limited manufactured 10,500 products during June. 20 times 9. And sold 10,900 products during June. So you could see here now we've got the possibility of having we have to calculate on our own the closing working process. Variable administration and variable marketing cost vary with units sold. That's something then that is quite obvious as you need to know. And you've been given then the other information, the actual cost then for the month of June, starting from the direct material up until then you got your selling price given there. Excuse me. Look at the requirement. There's a combined income statement for June 2009 using the absorption costing method, and you have to combine another one using the direct costing method. So we will look at those two income statements according then to the said method that we have. Let's save this. This was our chapter 13. Let's add another folder there for the new chapter that we're going to start today, chapter 14. So we look at that question 14.1. So we start now with our first step. Said that our first step is to work out then our units. Then when we look then at these units, we've got only one period here, only June. Because sometimes they can give a set of then 2 months or 2 weeks, then you have to work out the number of units for that 2 weeks. Look at the opening plus production is equal to units available minus then your closing, then you've got then your sales. We'll simply go back to the question and look at what is given then for us. There is information that there were 1,500 products in the finished goods storeroom on 31st May, 20 times 9. So if you say that 31st May, 20 times 9, and we're doing this calculation for June, therefore it means that 1,500 is an opening then in the month of June. Right, let's check then our production. In the month of June, then we produce how many units? MJ Limited manufactured 10,500 products during June 20 times 9. Production then is 10,500. What else then is given for us? And sold 10,900 products during June. So we do have that information about sales, 10,900. Now we can start working out then and see how are we going to get to our closing working process. We've got an opening of 1,500, production 10,500. So that give us a total of units available of 12,000. Because we add 1,500 plus or 10,500. And then out of the 12,000 units then that we had in the month of June, we made the sales of 10,900. Therefore, we left with how many units? So we say that we had 12,000, take out 10,900. Now we're only left with 1,100. So if you can prove this, then I say 12,000 minus 1,100. So it's going to give you 10,1100. So we'll finish then at the units because we're going to need these units when we do our income statement. That's your first step in terms of then the workings. The second one, we said that is a cost per unit. Then we look at the direct material. Again, the month is June only. Direct labor. Then we look at your variable manufacturing. That's going to keep you or to give you the cost per unit as per direct method. Then I will say add fixed manufacturing overheads to arrive then at to the absorption. To your absorption cost per unit. So that's then the skeleton. Now let's fit it. Direct material per product is 25 rand, 34 rand your labor, and 11 rands then your variable manufacturing overheads. So it's 25 rand, 34 rands, 11 rands. Excuse me. So that's it. 70 rands is your cost per unit as per direct method. Now we need then to work out an hour fixed. So as per the theory, they say that we absorb then at the fixed manufacturing overheads to the production. So what does that mean? You can't go, guys, then back to the information and said, oh, okay, this is then the budgeted 350, or you go and check the actual amount and say it's 380. So let me take this 380 and divide by the production. No. Once when we say that we absorb, it takes you back then to chapter 5. So where you were allocating using the budget information. So we are going to use then our budget information. Remember the formula then that you normally use to use there, where you take then your total budgeted manufacturing, then you divide then by the given base. And in this case, then our base is going to be machine hours, because then we're using the machine hours then to allocate then these overheads then in our production. So that's then our base. So it means then you do know, okay, I've got 350,000. Then we are looking for then the machine hours. What we know then after the machine hours is that it takes 2.5 machine, there it is, machine hours to produce one product or one unit. That's fair enough. We know that, okay, to produce one unit, it takes us in a 2.5 hours. And now in this case, our units that we produce, and we've got to 10,000 as per the budget and the standard information. So they gave us 10,000. So if then it takes us 2.5 hours to produce one unit, if then our standard production is 10,000, the question is how many hours? You do then what they say then is cross multiplication. Remember then one I will start say that, okay, probably then I may say then 10,000 and divide by 2.5. Remember that 2.5 is the hours. So you need then to take note of that. So the best way then to do then this in your cross multiplication, it will end up then being 10,000 times 2.5. So that you can be established, okay, is how many 2.5 then in total. Then you'll say, okay, it's 25,000 hours. So these are the number of hours and then we take then to produce 10,000. So we use that and go to say 350,000 divided by 25,000. Therefore, you've got 14 rands. Now listen to that per watt, per machine hour. Now the question is, are we looking then at the cost per machine hour? No, we are calculating the cost per unit. So you still need then to convert then these 14 rands to a cost per unit. Because then again, you know that it takes you then at this 2.5 to produce 1 unit. Once again, you'll take then at this 14 rand, simply multiply it by 2.5. Then it will give you 35 rands. 35 rands then is equal to then a 1 unit. So this is what we're looking for. I hope then that one was clear then to everyone. So we've got 35 rands. So it will be 70 rands plus 35. So the cost per unit according to absorption is going to be 105. Then you're done with your second step. We'll move on then to your third one. We said that the third one is to work out then your over or under allocation. So then you're going to take your actual fixed cost, then minus the allocated fixed cost. And we know that the answer is going to be either of over or under allocation. The actual fixed cost and given then in the book there, it is 380,000 in the textbook. It's given there. So we take then at the 380,000 is given then for us. Then allocated, then we're going to calculate the allocated. So there's your production. So you've got a production of 10,500 times then the allocation per unit, which is 35 rands. Because remember, then we've allocated this fixed cost to the production. That is why then we take 10,500 our production amount. And it gives us 367,500. And you say 380,000 minus 367,500. The difference is 12,500. And it's quite clear then, but this is an underallocated amount. Are you agree with me? Because then what they say here, we're supposed to allocate. And there's a mistake here. I know that over supposed then to be the one over in brackets. That will help us. So we were supposed to allocate 380,000, but we've allocated 367,500. So we were under by 12,500. And once you keep then the word under then out of the brackets, then it's easier to see, okay, now which one, then your answer is it an under or allocate or over allocated, because it was going to be over if then the allocated amount was more than the actual amount. So we've managed now to lay the foundation for the income statement. We can do then the first requirement, where they say that let's do the income statement according to absorption method. we start taking in by the sales. We do know that our sales, that is 10,900 and at a selling price of 114. It used then to be advantageous, and by the time then we were doing things then on a venue based, even when you do the solution to indicate then the calculations. Because sometimes then because of the pressure of the exams, you may have the figures right in terms of your calculation, but when you do your actual calculation, then you mess up some things. But if then you did indicate it, okay, these are the figures, you may get then those 1 mark or 2. So we've got 1,242,600. That's our sales minus cost of sales. So we're not given the cost of sales here, so we have to calculate the cost of sales on our own. This 1,242,600 must go then to this side. So we'll start looking at your opening. Now we are on absorption method, opening 1,500 from the first step, times then from the second step, the cost per unit, which is 105. Opening, then it gives you 157,500 plus your production. Our production is 10,500 at 105. So you could notice then that 105, it includes the fixed cost as the theory was indicated to us. It is your 1,102,500. And minus closing 1,100 times 105. That gives us 115,500. Then we call this production at standard. $157,500 plus 1,102,500. Then we minus 115,500. So our production standard is 1,144,500. And you've got your over or under allocation. The one that we've already calculated in step number 3, 12,500. Because now this amount is positive, so this 12,500, that simply indicates that to us, okay, it's going to be added, because it means then the amount that we've allocated to calculate that 105 is less by this 12,500 in total. So that means then our cost of sales has to increase by that 12,500. So we've got a grand total of cost of sales being equal to 1,157,000. Then your gross profit take 1,242,600 minus 1,157,000. So we've got a gross profit of 85,600. That's it. That's our gross profit. And from there, then we minus the non-manufacturing. Less than the non-manufacturing cost. Because we've already indicated or dealt with then all the manufacturing one. So we do have then the variable manufacturing, variable admin, fixed admin, variable marketing. So those are the costs that we have then that we're going to take into account now. Those then yes. Go then the variable then admin. If you look at this variable then admin, they say that is R1 per unit, and it is varied then according to the units and sold. That R150. So that means then I will go to 10,900 times R150. Then I will get to the 16,350. Then the next cost that we have, fixed admin, it is so the fixed admin normal, then we are given a total there because we do know that the total is the one that is constant. Fixed admin cost of 70,000. Then the last one is your variable marketing. We skip variable manufacturing because we've already included them in our production. Variable marketing, which is 75 cents a unit. It's a variable marketing. So is it 70 cents or 75? Oh, 75 cents. That gives us that 8,175. That's it. Then I will add the 16,350 plus 70,000 plus 8,175. So we've got a total of 94,525. So according then to the absorption costing method, we've got a net loss, because then you've got a gross profit of 85,600 minus 94,525 gives you then the net loss of 8,925. So that's an income statement according to absorption costing method. Then let's see then the one now of direct, that is B. Can you take then your sales? Nothing then that will change then as per your sales. 10,900 times 114. 10,900 times 114. You've got your 1,242,600. Now instead of saying now minus cost of sales, we say minus variable cost. And we said variable cost irrespective whether then is it your variable production or variable non-production. As long as it's a variable cost, we have to minus it there in this first column. So we started now with our variable production, where then you'll see us we're looking at the opening. We've got then the opening of 1,500. Remember in that first calculation that we've calculated let's go and check it. We did calculated the cost per unit as per direct method to be 70 rands. Now it's time then to make use of that. You could imagine then, guys, and if then you've made mistake on those cost per unit calculation, so that will mean that your calculation is going then to be wrong, and it's even a risk, and especially now then the test is being written then online, because there's no calculations that are being submitted, so you just make a wrong choice, and that's it. It's wrong. So with our opening inventory, it's 1,500 times 70 rands, and it gives us 105,000 plus and the production. We've got our production is sitting at how many units? 10,500. Times 70 rands. It gave us 735. So that's 735,000. And minus closing 1,100 by 70. 77,000. Then that will give you your production variable cost. then is equal to 763,000. Then we look at our variable cost that we have. If you look at here, we've already indicated, okay, we've got two variable admin and variable marketing. Some people then have got this mentality of thinking that now that we are going to include then up there, then well, let's use the production when we calculate this variable admin. But it's a variable admin is based on its sales, so you can not use the production then to work out then this calculation. It's always going to be your sales, as you did it here in under O absorption. So it won't change. You to say that 16,350. And again, you've got your variable marketing, 10,900 times 75. And it gives you then that 8,175. And we add then to that 763,000, the two figures, that is 16,350 plus 8,175. So our variable cost will be 787,525. Then your answer then is no longer gross profit, but we call it contribution. When we deducted to 787,525 from 1,242,600. So your contribution is 455,075. Then we say now minus, after that, your fixed cost. So you do have then the fixed production. So your fixed production or the fixed manufacturing, 380,000. Just take it as it is there. That is why probably then they call it a direct method, because it does things directly. Then another fixed cost rate with a fixed admin, 70,000. $380,000 plus 70,000. So we've got 450,000 in total. Then minus that and from that 455,075. So according to direct method, we do have a profit of 5,075. Here to absorption, then I gave us then the loss of 8,925. So then with this, and the companies can make a choice. Okay, now which method are we going to make use of when we draw up or when we do our reporting? Obviously, they normally used to go then with the one that gives them the profit. So that is why then we've got these two methods, so that each company can look, okay, now which one works better than for us. So that's how then you draw up then the income statement according then to the two method. And again, then once guys, then we've got this challenge or this problem, because we're using the same figures here, Yet then on the other side, in the direct, we've got a profit of 5,075. But when you check it in the absorption, you've got a loss of 8,925. So they say that once then your final answer is not the same, then you need then to reconcile. But then we are going then to look at that on Monday when we meet then in our live virtual class. So that's the end then of our today's session. Thank you. Thank you. Then let me stop my presentation and stop also then the recording.